Welcome to the Opening Bell Report.
We're looking at a sudden, incredibly sharp surge in the silver market. And with that price action, we are hearing a very familiar whisper making the rounds again.
Yeah, the return of the silver squeeze.
The silver squeeze. It's a phrase that instantly commands attention in trading circles.
Mostly because of the historical baggage attached to it, right?
Right.
But I've always believed that knowledge is most valuable when you can apply it to the current market structure, not just, past narratives.
And that's exactly what we're going to do. Today's deep dive is based entirely on a highly detailed analysis report that breaks down a massive anomalous market move by one specific entity. Right, the Sprott Physical Silver Trust. Our mission today is to uncover why a 6.01% single-day jump in this specific trust is acting as such a loud signal in a normally quiet room.
And understanding the hidden mechanics of this specific breakout could completely shift how you view commodity surges across the board.
Because we're going to explore the crucial structural differences between synthetic exposure and tangible assets, and frankly, break down the macroeconomic tailwinds that are turning this into a perfect storm.
It really is a convergence of technical price action, structural market quirks, and global macro shifts all hitting at the exact same time.
Okay, let's unpack this. Let's start by dissecting the anatomy of this breakout, looking right at the tick data from the analysis report.
The numbers here they're really telling.
Yeah, the catalyst for everything we are unpacking today is that undeniable 6.01% surge in PSLV. Now, if you're trading microcap tech or crypto...
6% is just a Tuesday.
Right, exactly, just a regular Tuesday. But in the realm of major established commodity trusts, a 6% single-day move is highly unusual.
It indicates heavy, sustained accumulation.
Yeah.
Major institutions or a massive coordinated wave of retail capital just stepping in aggressively.
And the analysis report breaks down the trading day specifically. PSLV didn't just drift upward on light volume. It gapped up right at the open to $30.15.
Right.
It pushed to an intraday high of $30.89, and crucially, it held those exact gains into the close at $30.89.
What's fascinating here is how the specific trading session actually unfolded. You have to look at that to understand the underlying bid. We really need to pause on that specific mechanic.
The gap up.
Yeah, holding a gap up in this macroeconomic environment is a major tell. Usually when you see commodity gap up at the open, you expect the early sellers.
The swing traders.
Exactly, the swing traders. You expect them to immediately take their overnight profits. You expect the price to fade back down and fill that gap.
But that fade never materialized. The selling pressure was just completely absorbed.
Completely. The sellers were exhausted within the first few minutes of the session. By gapping up, holding that level, and closing on the absolute high, the tape is broadcasting a very clear message.
Which is what?
Buyers are willing to pay a premium to secure their position immediately. They aren't trying to walk their bids down. They aren't waiting for a technical pullback to the moving average. They want the exposure right now.
That indicates a tremendous sense of urgency. And that kind of urgency instantly triggers flashbacks to the 2021 silver squeeze attempt.
Absolutely.
Back then, you had retail traders attempting to corner the market, and the charts look very similar. Relentless, aggressive buying pressure. But the narrative surrounding silver is usually so different.
It's traditionally viewed as this lethargic, slow-moving hedge against inflation.
Right. You buy it, put it in a safe, and forget about it. A session like this overnight shifts the market narrative from sleepy safe haven to aggressive short covering rally.
It flips the script entirely. And when you factor in the mechanics of a short covering rally, you get this massive feedback loop.
Because the entities that are short silver,
the ones holding synthetic derivative contracts, betting on the price to fall,
are suddenly forced into the market to buy the asset to cover their losing positions.
And that forced buying just accelerates the upward momentum even more. But to really grasp why this specific short covering dynamic is so potent right now, we have to look closely at the vehicle acting as the catalyst.
Which brings up the most logical question for anyone listening. If the market is talking about a squeeze, why is PSLV suddenly the star of the show?
That is the defining question of this entire deep dive.
Because if I'm a trader, why wouldn't I just buy silver futures? Or a massive, highly liquid exchange-traded fund like SLV?
The answer comes down to the foundational premise of the silver squeeze theory itself. The core argument, the reason a squeeze is mathematically possible, is the belief that the global market is flooded with fiat instruments and derivative claims.
Paper claims.
Paper claims that far exceed the actual ounces of physical silver sitting in the vaults.
So it's the fractional reserve banking model applied to a physical metal. People buy silver contracts and just assume the metal is sitting in a vault with their name on it.
But the reality of synthetic exposure is that they usually own an unallocated account, or a paper contract that promises price exposure without the logistical headache of delivery.
It's like trying to claim your coat from the coat check at the end of the night, only to realize the venue handed out 3 claim tickets for every jacket.
That's a great analogy. The system works perfectly fine as long as everyone doesn't decide to leave the party at the exact same time.
Right.
The derivative market for silver assumes that the vast majority of participants just want to trade the financial spread. They never intend to take physical delivery of a 1,000-ounce commercial bar.
Here's where it gets really interesting, and the analysis report details this beautifully. The Sprott advantage changes the game entirely. PSLV is not a standard ETF playing the derivatives game.
No, it's not.
It's a closed-end trust, and its mandate is to hold fully allocated, unencumbered physical silver.
That distinction is everything.
It's not lent out to short sellers. It's not rehypothecated as collateral for another trade. It is tangible metal, locked down.
And that specific legal structure creates a powerful vacuum effect on the wholesale silver market.
How so? Walk us through that.
The engine driving this is the at-the-market, or ATM, offering mechanism. When capital floods into PSLV, whether from retail traders or institutional hedges, the trust frequently utilizes its ATM to issue new shares.
Okay.
But instead of just holding that cash, the trust's mandate forces it to go directly into the wholesale market, purchase the equivalent value in tangible silver bars, and remove them from circulation.
Wow, so it's a direct transmission belt. Capital flows in and tangible supply is drained from the commercial vaults.
It is a one-to-one extraction. You allocate capital to the trust procures the bullion, and those bars are permanently taken off the chessboard.
I get the structural advantage of fully allocated metal, but let me play devil's advocate for a second here.
Go for it.
If I am a retail swing trader, or even a mid-sized hedge fund, I might look at SLV, the major competitor, and I see its massive average daily volume and incredibly tight bid-ask spreads.
Sure.
I might think, why do I care about physical allocation? I don't want the silver delivered to my apartment. I just want to capture the 6% price pop, and SLV gives me the liquidity to get in and out flawlessly. Why does the tangible aspect actually matter to me as a trader?
It matters because of counterparty risk and supply elasticity. SLV relies on a complex network of authorized participants.
Major bullion banks.
Exactly. And it heavily utilizes cash settlements and synthetic contracts. If the ultimate goal of the market is to force a squeeze and drive true price discovery, buying synthetic exposure is just opening a relief valve for short sellers.
I see.
With an authorized participant model, the actual delivery of the metal can often be delayed, deferred, or settled in fiat currency.
So the direct link between your invested dollar and the physical removal of a bar from the market is broken.
Or at least highly obscured by financial engineering.
So buying a paper derivative might get you the intraday price action, but it doesn't fundamentally alter the supply-demand equation. You are just trading another one of those extra coat check tickets.
Precisely. But buying PSLV directly tightens the physical supply chain. You are actively forcing the venue to locate another actual jacket.
And that physical tightening mechanism is what takes a squeeze from a theoretical chat room exercise into a real-world supply shock.
Exactly. But we have to ground this conversation a bit. A squeeze mechanic only works if the underlying asset is actually scarce.
Right. A vacuum is only effective if the room is already running out of air.
Which is why we have to separate the financial engineering and squeeze hype from genuine macroeconomic drivers. It's not just market enthusiasm, it's fundamentals.
And the analysis report points to fundamental structural forces that are absolutely devouring the physical silver supply right now.
We cannot ignore the macro data. Silver occupies a very unique dual identity in the global economy. Historically, it is a monetary asset. But today, it is arguably the most critical industrial component on the board.
Right, industrial demand.
And that industrial demand side is currently undergoing a violent structural shift.
The report highlights 2 specific sectors that are cannibalizing the available supply: solar photovoltaics and electric vehicle electronics.
Both of these industries are scaling exponentially, subsidized by massive global green energy initiatives.
And both rely heavily on silver because it is the most electrically and thermally conductive metal on Earth. You can't just engineer it out and swap in copper or aluminum without suffering a massive loss in efficiency for those solar cells or EV relays.
You really can't. The silver paste used on silicon wafers in solar panels and the hundreds of electrical contact points inside every single electric vehicle represent an inelastic demand.
Meaning they have to buy it no matter what.
The manufacturers have to buy the metal regardless of the current spot price because their production lines depend on it. This surging industrial consumption has created a confirmed structural supply deficit.
The numbers on that are wild.
We have reached a critical inflection point where the global economy is consuming significantly more physical silver in manufacturing every single year than the entire global mining industry is pulling out of the ground.
When you run an annual structural deficit like that, the commercial above-ground stockpiles have to shrink to make up the difference.
They are actively draining. And as those stockpiles diminish, the wholesale market becomes incredibly fragile and tight.
But the industrial sector is only half the battlefield here. While the EV and solar manufacturers are desperately trying to secure vaulted bullion to keep their assembly lines moving, the financial sector is simultaneously making a run on the exact same metal.
For entirely different reasons.
Right. We have to factor in monetary policy. Any hints of central bank rate cuts or sustained inflation that degrades purchasing power makes non-yielding tangible assets highly attractive.
If we connect this to the bigger picture, you see a perfect storm forming on the horizon.
On one flank, you have central bank liquidity cycles and fiat debasement making cash an active liability, which drives institutional hedges into precious metals.
And on the other flank, you have massive safe haven flows. Historically, whenever geopolitical uncertainty spikes, and the current global landscape is exceptionally volatile right now, frightened capital abandons risk assets and runs toward the historical safety of vaulted bullion.
So putting the puzzle pieces together for you listening, you have industrial giants mandated by green energy policies fighting to secure physical silver just to maintain operations.
Yep.
Simultaneously, you have global investors fleeing fiat instruments, using vehicles like PSLV to vacuum up the exact same physical bars to protect their wealth.
Both factions are aggressively pulling from a commercial supply pool that has been operating in a severe structural deficit for years.
That is the fundamental underlying reality that justifies the violent price action we saw on the tape.
The 6% surge isn't just an anomaly. It's the market attempting to price in this massive supply-demand imbalance.
So what does this all mean when we look at the charts? Let's bring this back to the technical setup and the final verdict from the analysis report.
Let's look at the actual levels.
We established that the current price of PSLV, following that massive surge, closed at $30.89. But to put that in context, the 52-week range for this trust, the lowest and highest points it has traded over the past year, is from $9.96 all the way up to $38.12.
That specific data point reveals a counterintuitive reality about the current market psychology that technical traders are keying in on.
Because despite a massive explosive daily move, sitting at $30.89 means it is still trading significantly below its 52-week high of $38.12.
Exactly.
Yeah.
A novice trader might look at it being down from its yearly highs and assume the asset is showing relative weakness.
Right.
But from a strict technical analysis standpoint, this setup is wildly bullish. It indicates that the breakout is entirely fresh. The upward momentum has only just triggered.
And it leaves substantial runway.
A very long runway before the price runs into that major historical resistance level at $38.
When an asset makes a violent high-volume move upward but still has that much clear air above it, it creates a highly favorable risk-to-reward ratio. It actively invites more momentum algorithms and technical traders to jump in, adding fuel to the fire.
The runway is clear, the volume is confirming the move, and the macro fundamentals are providing the fundamental tailwind.
So delivering the ultimate verdict from the analysis report we've unpacked today, is the fabled silver squeeze actually back in play?
The conclusion is nuanced.
Proving the explicit intent of a coordinated, targeted squeeze like we saw in 2021 is nearly impossible in real time. You can't definitively prove why thousands of disparate actors are hitting the buy button.
But the undeniable mathematical reality, proven by the volume and the specific vehicle chosen, is that a massive wave of capital just hit the physical silver market.
Intent becomes irrelevant when the market mechanics are this absolute, because PSLV acts as a direct vacuum for physical supply, taking tangible bars out of circulation and locking them down.
This capital inflow isn't just a synthetic abstraction. It is not just green numbers ticking up on a broker's screen.
It represents real-world supply tightening in a market that is already mathematically starved for metal, not just a blip on a screen.
Exactly.
Which brings us to the core value you can take away from this deep dive today. We've navigated a lot of complex market mechanics, but if you remember one vital concept, let it be the stark difference between trading synthetic paper derivatives and capturing tangible market forces.
That's the key takeaway.
The next time you see a commodity surging, ask yourself, is the market trading paper promises, or are they fighting over the physical element? Because when a system is leveraged to the hilt with fiat claims, an asset that demands tangible delivery acts as a profound disruptor.
You now have the lens to see the incredible convergence happening behind the curtain.
Inelastic industrial demand colliding head-on with monetary safe haven flows, all warring over a shrinking vault of actual metal.
Which raises an important question. A critical, longer-term implication that isn't showing up in the current trading data, but is something you should absolutely monitor moving forward.
What's that?
Well, we've established that the industrial sector is locked in a structural deficit, and financial vehicles are vacuuming up the remaining physical float. But if industrial demand for solar and EVs continues to skyrocket and physically deplete the silver supply, while investors simultaneously vacuum up the remaining physical bars to hedge against inflation,
Right.
at what point does the industrial supply chain completely fracture? I mean, if the vaults actually run dry, do global green energy initiatives simply grind to a halt? Or does an absolute supply failure force an immediate, massive technological leap to engineer silver out of solar panels and EVs entirely?
Oh, wow.
And if industry is forced to innovate away from silver just to survive, what does that sudden destruction of industrial demand do to the metal's long-term value once the squeeze is over? And how would the paper derivative markets even survive that reckoning?
That is an incredibly provocative final thought to consider. A potential future where the very squeeze that drives the price to the moon forces the technology sector to abandon the metal entirely. Thank you so much for joining us on this deep dive. I hope we've given you a sharper toolkit to cut through the financial noise. Keep questioning the underlying numbers, stay skeptical of the paper illusions, and we will catch you next time.
Don't forget to like, share, and subscribe for more.